webinar on real estate debt investment. In the UK, everything is changing. We have a new government that has declared its mission to build, build, build. The previous Conservative administration hit its housing target 0 times in 14 years. There's one estimate that the UK has 4 million fewer dwellings per capita than France, all of which has led to a potential boom in property and real estate. And investors and independent financial advisors are asking, well, how do we get involved? What's the best way? And where should we invest? Which regions in the UK should we be looking at? We know that London is on the radar of every international development corporation, but maybe there are other areas, such as the Northwest. So to find out, we've invited 3 of the UK's leading property experts to discuss debt investment. So may I introduce our panel for today. Damien Ainsley is the Investment Director of PMJ Capital. Established in 2014, PMJ provides short-term property finance on a range of residential and commercial properties. Damien, if you turn your camera and mic on, we'll say hello to you. Damien, hi, how are you doing?
Yeah, very well, Charles. Thanks for the invitation.
I'm pleased to say our timing is so good, just listening to what the Labour government has been saying about house building. It does look as though we're on the verge of a boom. So from our perspective, this conversation couldn't be happening at a better time. Let me also introduce Adam Wood, who is the CEO of Advantage Investment, which is an award-winning off-plan property specialist. Adam, hi.
Hi, Charles. Hi, Damien.
Yeah, great to have you. And just completing the panel, I'm really pleased to welcome the experienced voice of industry veteran Dave Simonson. Dave, you turn your camera on. Dave is director of Devbrook Limited, a property finance specialist. But yeah, those who know and have worked with him will tell you there's not much about property finance that Dave doesn't know. Dave, wonderful to have you with us.
Thank you, Charles. Hi, Damien. Hi, Adam.
So our objective today is to give all of our viewers a really comprehensive overview of how to invest, where the best locations are, what the best strategy is, but also some of the pitfalls. We want this to be as real and as helpful as possible, no sugarcoating. So perhaps we're going to start with the opportunity. I mean, everyone knows, London's got opportunity, but it's, as I said, on the radar of everybody. The Northwest, however, wonderful growth potential, maybe underserved. Damien, just tell us, why should investors be considering the Northwest? And just tell us also where the Northwest is for people who aren't quite sure where its boundaries are.
Yeah, so Northwest as a region, depending on how specific you want to be about it. For us at PMJ Capital, that means from the top of Cumbria down to the bottom of Cheshire, and we also cover a little bit of Wales. So North Wales would classify for us as Northwest.
Fantastic. And Adam, if I could put this to you, the Northwest, just give us the pitch. For those of us who don't live there or work there, we kind of get some impressions of some of the hotspots. Footballers' wives love Cheshire, but just talk us through the region a little bit and why it's maybe a really special place in terms of property investment.
Yeah, Cheshire's fantastic to live, but I probably wouldn't invest there. Not covering the whole of Cheshire, but it's quite expensive. So okay. I think that most of our investors at the moment are looking. Manchester's been on everyone's radar for the past 3 to 5 years, I'd say. And if you'd invested in Manchester 5 years ago, you'd have done really well. Liverpool at the moment, it's got £5.5 billion worth regeneration going in. So the largest ever planning permission that's ever been granted in the country. It's on right along the docks there. So the massive influx of people sort of moving now from Manchester to Liverpool. And if I had to pick what was next, I'd probably say Hull. It looks like it's going to be a good one since the capital of culture. I know that might be a little bit out there, but that 5 years' time, I'd say Hull would be a good place to invest as well.
Well, who knows? Because the working from home aspect means that people are looking further afield. The idea that everyone has to be crammed into Zone 2 in London, false. People are moving further away. So, yeah, Hull, who knows? Could be a very good call. Dave, where do your eyes turn to when you look for property hotspots?
I think over decades the hotspots have massively increased. As you've all rightly said, it was all focused around London, but with commuter links being so much better than they've been, people working from home, flexible working, The main focus is around the main cities in the UK that have good connection commuter links, which, to be fair, most of them have now. The Northwest has exploded in the last 10, 15 years in terms of development. Is a great area, and I work with a number of clients in that area. So it's a very, very prosperous area and a good area to invest.
Great. And Damien, just sketch out for us the investment potential, because a lot of people think, well, if I want to invest my money in property, maybe I've got to do a kind of, home renovation concept myself and go to the bank and take out a mortgage and buy a single place and do it up and flip it. That's a lot of work. A lot of people are not suited to it. But there are, of course, many other ways to invest. Just talk us through some of the opportunities for maybe sort of higher net worth individuals.
I think for the vast majority of people, we all understand property to some degree or other. We live in homes, whether renting them or owning them, and we pick up newspapers and read articles online. So we have a fairly broad understanding of what property ownership and being a landlord might look like. But there are alternatives out there. As I'm sure Adam will be able to testify, buying properties, new builds, and renting those out, looking for growth or looking for the rental income is one method, but one that's really capturing the imagination at the moment in the mainstream more recently is real estate debt investments. So as opposed to actually owning the physical asset, you actually lend money to the developers and the builders of that asset in the form of a loan. So that might be for a 12, 18, maybe 24-month period at a fixed rate of return usually. And the investment that you make is repaid back to you at the end of term plus interest. Relatively simple and straightforward process. Comes with some challenges and pitfalls and potential risks, as everything does. But it's a really, really interesting space that has historically been institutionally led. Certainly the mainstream banks. That's changed since COVID in particular, where the banks have kind of pulled back on some of their lending criteria. That's left a gap in the market for lenders like ourselves to be able to step in, provide that capital for developers and property investors to be able to continue that development that hopefully the new government coming in are going to push even further forward. But that opportunity is now trickling down into the zeitgeist of the retail investors. Certainly IFAs and wealth managers are paying more attention to it to expand their clients' portfolio of investments.
And just follow through on that. So an individual has a sum of money. What do? They hand it over to you and you invest it on their behalf?
Yeah, so there's a varying number of ways that can be done. The two most common ways. One is through a real estate debt fund, and there are a number of them out there for anyone from Goldman Sachs down to smaller boutique investment houses. Or you can invest directly into a specific loan, again, usually via a boutique investment house, a little bit like ourselves, where we'll present you with a specific loan on a one-to-one basis, so one investor to that specific loan, and they will provide the capital for it. We'll secure that capital against the asset as a legal charge. As an entity ourselves, we only operate on a first legal charge basis, which means should anything go wrong with the development or the refurbishment of the property, then we'll have the opportunity to actually recover the capital via recovery of the asset.
Okay. Dave, give it to us straight. Is this a realistic investment opportunity for ordinary people? I mean, a lot of people will be just thinking, no, I don't know, I stick to my stocks and shares. This is a new asset class for me. It sounds like it could be complicated. I mean, clearly it is more complicated than just buying some form of, diversified ETF and forgetting about it. But how realistic is this for ordinary people to invest in?
I think in the UK, it all starts with property. When you're as you're growing up, you're always encouraged to buy property, invest in property, and like any investment, it's about mitigating the risk. So property is obviously a very solid asset, and everyone feels comfortable with that. But when you're putting money into a refurbishment project or a development project, it's about mitigating the risk. So the things you want to be looking at is how long has that company been trading for? What's the experience of all the individuals within the company? How many loans have they written before? How many losses have they incurred before? What areas do they operate in? So all these questions are important because they're ways of mitigating the risk. And obviously PMJ operate in the Northwest and have got very good experience.
Those are great questions. It's almost worth writing down and bullet pointing, almost for any investment, actually. Those are university great questions. Adam, I can see you nodding there. So supposing you have a relative who is thinking, yeah, I want to get involved in this. I want to make, property investing through, debt investment part of my portfolio. What advice do you have for them for working with the right partner, but also minimizing risk?
Yeah, I think it's very similar to what Dave just said. You've got to be very precise and clear, and some investors get a little bit excited too quickly and see the end goal. And I think it's really important to have someone like PMJ who can sort of say, look, these guys are solid. We've worked with them before. They've got a great track record. We're going to be doing it for this side. And they've also done their professional due diligence. And I think that makes a massive difference. I know, especially in my industry with the off-plan side of things, developers in particular, some get an influx of money and just decide they want to build, and it could be good, but we try to work with the ones who've got a great track record, the ones who've got everything sort of lined up before going out to get investment. They've got other funding lines, and it just makes the whole investment more secure. Now, you're never going to be 100% risk-free, as with any investment, but I think with property, if you've got a sort of long-term, mid-term goal, usually if you do your due diligence, it can always be fruitful.
Fantastic. Okay, Damien, just talk us through the mechanics of it. How does it actually work? I mean, talk us through things like time frames, legal contracts. I mean, what actually is involved? Because other investments are really simple. I mean, you can invest in a stocks and shares ISA or ETF in a space of 10 minutes and then forget about it for the next few years. This is clearly going to take a little bit more work on the part of the investor. So just how does it actually work?
Well, it's interesting when you refer to how easy it is to purchase stocks and shares. What's complicated with regard to buying into shares of a business or a company is what goes on behind the scenes. And the same would apply with real estate debt. It is very simple to provide an entity like ourselves with a chunk of capital that we will deploy into a given loan. But what goes on behind the scenes is what really makes the investment work or not. So for us, we'll obviously do due diligence on the developers themselves. What's their track record like? What's their legal standing like? What's their financial position like? We'll look at the actual structure of the deal, i.e., how much are they looking to borrow? How much will it cost for them to develop? What are their margins? Before we actually take a decision that, yes, it's something that is viable. The most important thing for us is security, ensuring that any finance that we provide to a developer is secured at a maximum loan to value, which means over the lifetime of the build, of the development and the sale process, that there's enough fat in the deal, so there's enough equity in the deal that should anything go wrong, i.e. an overrun on material costs or an overrun on delivery time, that the capital is not impacted. So we'll go to a maximum of 70% loan to value or 85% loan to gross development value. What that means is that there's 15% of the gross development value that could fluctuate to enable to mitigate the risk of capital losses. Over and beyond that, securing the finance against the asset, that's a legal process. So we have legal partners that we work with to make sure that's drawn up and appropriately put in place. And that's it, fundamentally. A relatively simple process from our point of view. But again, it's important that all of the people involved in the process are experienced, They've got track record, they know what they're doing, and that they've shown delivery in the past.
Okay. I'm interested in the kind of returns people can get. We have good data on more sort of easily tradable assets. S&P 500 annual movements are well published. Bond yields are well known. This seems a little less predictable, or is it? I mean, Dave, what kind of returns do you think are realistic for this kind of investing?
There's various different products in the market and that are available, but generally speaking, around about 8 to 10% return can be seen in these type of investments. You can get some that are higher, but it's all relative to risk. So, for example, Damien's product is very tightly managed. It's a very conservative loan to value or loan to GDV. Others operate with sometimes higher loan to value, like higher loan to GDV, but therefore offers a higher return, but the risks are higher. So it depends on what your appetite to risk is. Damien's operate on quite a tight loan to value and a loan to GDV. So therefore, I would expect the range of the investment to be at the lower end.
Okay, that's very interesting. And Adam, perhaps you could just talk us through the way people can identify a great opportunity. And we've talked about high risk does have higher yield, but there are ways of maximizing both of those. In your opinion, what is it? Is it the partner you're working with? Is it the location? Is it the deal type? Is there a complex matrix of all of those things?
Yeah, I think it is a little bit of all of those things, but I always look for timing, and I think there's a right time to invest in each place, each city, each location, and again, going even deeper into that, each certain area within that location and city. So, for example, at the start of the call, Manchester, I mentioned 5 years ago, was massive, and a lot of people who, especially overseas investors, were just going straight into London. When we were trying to sort of say, okay, look, Manchester's going to sort of be the next thing, and 5 years ago, Manchester, you could get a one-bed apartment for 125,000, which it's one of those days. So I think timing's massive, especially in this real estate debt investment side of things, because build costs, again, if you were to build just before the Brexit scenario and everything like that, it would have been a little bit less. So the profit margins for the developer are a little bit higher. So they've got more wiggle room and more contingency, where now the build costs are quite high and developers are actually getting squeezed a little bit. So again, working with the right funder is essential at this point for developers. And again, there's a circle effect where the developers hit, the funders hit, the clients hit. So if everyone's on the same page and almost like a partnership, it works so much better. And so, yeah.
Now, I love that word timing, partly because it gives people investing in the stock market the heebie-jeebies. Everyone, timing clearly is the secret, but everyone has their own, secret sauce. For Warren Buffett, the great investor, his timing, he says he likes to buy, assuming he's going to hold forever. Everyone has different ways of getting a feel for a location, certain metrics, whether it's population growth, whether it's government investment. Just give us the clues, Adam, as an experienced guy. When you say, maybe Hull could be up and coming, what are the little indicators that give you a flavour of where a place could be going?
Hull won Capital of Culture. Don't quote me on the year, but not too long ago. And it's following the sort of same trajectory as what Liverpool did when Liverpool won Capital of Culture in 2008. I'm obviously from Liverpool, so I've seen it sort of firsthand, but I don't know if many of you guys came to Liverpool before 2008. It was not the same, let's say. So, and since then, the money that was pumped into it just in the city centre alone attracted the bigger developers from the outside who seen an opportunity, and Liverpool sort of blessed with the waterfront that it's got. So the whole city centre is almost stretching at the moment. And we're 10, 12 years on from the Capital of Culture, maybe even more, and it's still providing a great sort of asset class. And Hull at the moment is pretty much the same. It's went up with the rest of the country in terms of usual house price increase, but hasn't had the actual push or just natural push above everything else, which Liverpool, Manchester has had. I think that the Northwest in general, in my opinion, will probably grow 25 to 30% over the next 5 years regardless. So if you can pick a good development within that, you can really increase it.
Nice, Dave. I can see you nodding away there. I mean, clearly, we ideally want to find places that are just a little bit ahead of the curve. You know, every smart ass is invested in Battersea and Clerkenwell in London. Too late. The market has already factored in all known information. But you think maybe there are some areas, Dave, in the northwest, maybe even northeast, that are a little underserved, are a little less well known, and therefore the gains are going to be much, much larger potentially.
Yeah, definitely. It comes down to a number of different factors. Obviously, you know, generally speaking, incomes haven't been kept up with the inflation rates of property prices. So with the commuter links being so good and working from home, people can work in all different parts of the UK now. So it's massively changed. And when you look at the demand in certain areas, and I've got, again, a couple of clients in Hull, the demand is huge in that area. So it's, you know, you've got all these areas because the people need to have housing, but they need to be able to afford it. So there's many up and coming areas that are going to flourish over the next years, just like Manchester and Liverpool have done.
Can we talk about the difference between commercial and residential? Because, you know, working from home has become something of a phenomenon. I think something like rail transit figures were down 40% after COVID, as people realised they could work from home for 2 days, 3 days a week. Many companies are now acquiring offices that could not possibly host all of their employees at the same time, but they're never going to need to. So there's some more question marks over commercial real estate. Damien, how do you see this? I mean, is there a rebalancing maybe between residential? People realise they're going to spend more time at home and therefore want larger homes, and maybe some of the more commercial developments are slightly riskier. How do you see it?
There's been a shift in relation to the view on commercial property from an investment standpoint. I think we've seen it, or we certainly saw in the news over the course of the last decade or so, the talk of the demise of the high street because of certain ways that we shop now. And we saw a lot of the sort of planning proposals around high streets being converted into more residential environments. And I suspect that will be a large play with a commercial property. There'll be commercial conversion to residential, which will satisfy, I guess, two objectives there, which is providing more houses for people or homes for people to live in, but also utilising those assets so they don't become white elephants in town centres. Our focus at PMJ is predominantly residential anyway. Okay. So we don't necessarily find ourselves involved in providing capital at large scale to projects that potentially might come out as problems if they haven't got industry tenants to go into. So our focus is residential. Commercial, there's always a way around an issue, and as I say, commercial to residential is certainly one of the routes that's being taken there.
Great. Yeah. Again, Dave, I can see you nodding there. I mean, has commercial become maybe riskier? We're just not sure how, sounds very philosophical, but how human beings are going to live in the future. I mean, the high street shopping, is that a thing? I mean, Amazon's crushed everybody. The way people live has changed, doesn't it? So has commercial become a bit riskier?
Yeah, it depends on the asset type. I mean, you know, commercial can it describes many different variations of it within it. You know, it could be storage units, it could be offices. So it does depend on the asset type. It depends on the location. You know, just to confirm what Damien said about commercial to residential, obviously there's been some favourable changes to planning and PDR, which enables conversion of commercial units into residential. And ultimately, the owners have to get a return on their asset. So if an area has dynamic changes within it, and it means that a residential conversion works better and gives the return, then obviously that's what will happen. But the planning changes have definitely helped, you know, within the market.
Okay, we've got 5 minutes left. I just want all three of you really just to try and provide some finishing thoughts. Really, I'm assuming people watching this are thinking, yeah, maybe this could be right for me. Maybe I do need property in my portfolio, quite rationally. But maybe they're just a little bit concerned about understanding the equation fully. I mean, nothing's ever as simple as things appear at first glance, but it does appear to be a straightforward route to market. Adam, what are we missing here? For people watching this, thinking, yeah, maybe, what reassurance or even skepticism can you offer? What guidance can you provide people who are thinking of investing this way?
It's not as bad as everyone thinks, honestly. There's enough experts in the industry to have a normal conversation and learn a lot within the space of a 5-10 minute period, or at least as much as you need to know. So my advice would be, if you are thinking about doing it, just speak to someone. You literally type in Google. All three of us here have got different sorts of aspects in the industry. You speak to each one of us and you'll learn different things about it. So yeah, my advice would always be just speak to an expert, let them understand your questions, because everyone's is different and everyone's goal is different, essentially. Some are doing it for the pension, some want a little bit more money every month, some are sending the kids to university. So there's all different targets, which means that there's different types of investment that are more beneficial for that person. So speak to the experts, let them answer all your questions, and the process actually isn't as dreading as everyone thinks. It's actually quite simple.
So you three guys are just happy for people to message you out the blue and pose a question?
Yeah, 100%.
Yeah, absolutely, yeah.
That's really, really encouraging. I just also wanted to ask about independent financial advisors, what your opinion are of them. I'm personally a little sceptical on IFAs. Some have great training and experience. Some are worryingly young. Dave, what's your opinion? Who's a good person to talk to about this kind of stuff? Can people just go to their hopefully regulated independent financial advisor and ask?
It's the same in any profession. It comes down to people. So, you know, in every profession, you have some very average people and you have some exceptional people. So, again, having plenty of grey hair, you know, I would always go down the side of experience and dealing with individuals that have been doing it a long while, because they've seen more things. They've seen the upsides, they've seen the downsides, and that's where you learn.
You definitely do learn. And the final question really is about timeframes. When people are investing, whether this is a kind of 3-year thing, 5-year thing, or whether this is a kind of revolving finance thing, that once you get a flavour for property and you learn more, whether this actually becomes part of your portfolio for life. Adam, what do you think? I mean, does property become just part of people's natural portfolio?
Yeah, 100%. We this year alone, we've helped, I don't want to put a number, but basically 40% of clients who purchased with us last year have now purchased again this year already. So, yeah, you do get a flavour for it.
And Dave, what's your experience when you're an industry veteran? When people get into investing this way, is it something that stays with them?
Yeah, the important thing is the first time. So, you know, once you do it for the first time, spend time speaking to the relevant people, get comfortable that you're making a prudent investment. And then that decision, when it goes, as Adam has said, when people make that first decision, they do that investment and they see it successful, well, they go again. It just makes sense.
And Damien, just to finish off, really, what words of advice do you have for people who've watched this webinar and are thinking, yeah, maybe I'd like to take the next steps? What can you tell them about the kind of, mindset, and also about the time frame they should be thinking about? Is this going to be something they see returns on in 2 years, 3 years, 5 years? What advice do you have for people?
So the typical time frame for an investment into a particular loan would be anywhere between 9 and 18 months. That's a typical time frame. Our average is around about 13 months. So it's worthwhile knowing that with a property, you might be purchasing property that you're going to hold on for 5, 10, 25 years. With an investment into a particular loan, you can recycle that capital every 2 or 3 years into a couple of different loans if you wish. So the ability to access your capital again is there within 12 to 15 months. Your ability to recycle. So in purchasing a property, you might need, let's call it 250,000 in cash, whereas you'll hold on to that property. That money is locked in for however long you want to hold on to the asset. With the real estate debt financing that you're providing, you can recycle that every 18 months. So you can continue to get the yields and returns that you would expect from a property or more, but you get access to that capital a lot easier as and when you need it. I would always suggest speaking to a financial intermediary. We work with high net worth, sophisticated and intermediaries. And if they want to look over any of our literature, if you and your advisor want to come in and speak to us, we're more than happy to be transparent, lift up the lid and show you how it all works.
Okay, guys, thank you so much. We'll wrap it up there. But I love the philosophy of diversification, of flexibility, and also working with experts. A lot of people believe to invest in property, they've got to do all the work themselves. They've got to go it alone. They've got to buy a property. They've got to figure out all the legal stuff all by themselves. It's an arduous and actually quite high risk strategy. Investment professionals will always tell you, work with experts, take advice, diversify, try and seek liquidity where you can, lower risk when you can. And this approach does seem to meet those requirements. So it's been educational for me, and I hope so for all the people watching. So from myself, from Damien, from Adam, and from Dave, thank you very much for watching.
Thank you.
Thank you.
Thanks, guys. Bye.